Don't overpay taxes by overlooking these tax deductions. Today, I have 5 of the most common deductions taxpayers miss on their tax returns so you can keep more money in your pocket. The most recent numbers show that more than 45 million people itemized deductions on their 1040s, claiming $1.2 trillion worth of tax deductions. That same year, taxpayers who claimed the standard deduction accounted for $747 billion. Some of those who took the way out, you probably shortchanged yourself. The first most overlooked tax deduction is the state sales tax. This write-off makes sense primarily for those who live in states that do not have an income tax. So these are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. So here's why this is effective. You must choose between deducting state and local income tax or state and local sales tax. For most citizens of income taxing states, the state and local income tax deduction is usually the better deal. For those of us who live in income tax free states, there are 2 ways that you can claim the sales tax deduction on your tax return. One, you can use the IRS tables provided for your state to determine what you can deduct. In addition, if you purchase a vehicle, boat, an airplane, a home, or major home renovations, you may be able to add the state sales tax that you paid on these big ticket items to the amount shown in the IRS table up to the limit for your state. Or 2, you can keep track of all the sales tax that you paid throughout the year and then use that. The best way to see what you can deduct is to use the IRS sales tax calculator. Number 2, reinvested dividends. This isn't really a tax deduction, but it is a subtraction that you can save a lot of money. And it's one of the many taxpayers miss. If, like most investors, you have a mutual fund and stock dividends automatically reinvested in extra shares, remember that each reinvestment increases your tax basis in the stock or mutual fund. That in turn reduces the amount of taxable capital gain when you sell your shares. Before I go on, tax season is upon us. The IRS opens on January 23rd. If you need a tax prep checklist, I have linked one in the description for you. Number 3, out-of-pocket charitable contributions. It's hard to overlook the big charitable gifts you may make during the year by check or payroll deduction, but the little things add up too. You can write off out-of-pocket costs you incur while doing good deeds. So maybe you drove your car for charity in 2022. Remember to deduct 14 cents per mile. 4, student loan interest paid by you or someone else. In the past, if parents or someone else paid back a student loan incurred by a student, no one got the tax break. To get a deduction, the law said that you had to be both liable for the debt and actually pay it yourself. But now there is an exception. You may know that you might be eligible to take a deduction, but even if someone else pays back the loan, the IRS treats it as though you gave the money and then you paid the debt yourself. So a student who's not claimed as a dependent can qualify to deduct up to $2,500 of student loan interest paid by you or paid by someone else. And then number 5, moving expenses. While most taxpayers lost the ability to deduct moving expenses beginning in 2018, one major group of people who still can claim their moving expenses to the IRS, they are military personnel. If you're an active military duty member who is relocating, you can still deduct these expenses if you don't receive reimbursement from the government for that move. Also, as long as the move is permanent and your relocation is ordered by the military, you don't have to pay taxes on qualified moving expenses reimbursement. I hope you have found this information helpful. Make sure that you hit that like and notification bell so that you don't miss any of this information. If you have questions, leave those in the comment box. Until next week, stay well.